Alrighty, ladies and gentlemen, welcome to another episode of Hawai'i Commercial Kitchens Technical Assistance. This week we are joined by Dr. Brett Carey from Edward Jones. He's going to be talking with us about financial planning. Okay, so to get started, I'll just do a little brief introduction of our program here for those of you that aren't familiar. This program overall is part of the U.S. Department of the Treasury, State, and Local Fiscal Recovery Funds program authorized by the American Rescue Plan Act. The County of Hawaii is a recipient of that program, and through the Food Security and Agricultural Initiatives program, made about $5 million over 6 categories available to Hawaii County food-related businesses and commercial kitchens. So this program is part of Category 4, the Certified Kitchens Cohort Technical Assistance Program. So Brett is our financial planning technical assistance provider in this program, and in addition to this workshop, is also going to be able to meet with eligible recipients one-on-one to provide free financial planning services. So Brett, thank you so much for joining us. A little just rundown of the program. In addition to financial planning, business coaching, HACCP plans, personnel management, marketing, permitting and compliance, and commercial kitchen management are all technical assistance areas that eligible recipients can receive free services towards. If you are a food-related business in Hawaii County that's been in operation since March of 2020, then you are considered an eligible recipient, as long as you've been negatively impacted by COVID, which was everybody. Shout out COVID. So this is a financial planning multi-hour Zoom class, so I'm gonna have to throw in some sound effects just to make sure everybody's on their toes. Brett, I hope that's okay.
Totally.
And you can learn more about the program at hawaiicommercialkitchens.com. So without further ado, I'm gonna pass it over to Brett so he can introduce himself, and then we can go through the Zoom and do a quick round of introductions just so Brett knows who he's talking to.
Okay, great. So to introduce myself, first I just wanted to say thank you all for being in the farming and farm-to-table business. I myself am a very strict vegan, and actually when I was little, I was diagnosed with cancer as a kid. I had large intestine cancer, and so I had a couple surgeries to remove the cancerous polyps, and after that, the doctor said, well, you have a lot of precancerous changes, and so the way you're going to keep this from becoming full-blown cancer in your 20s and 30s is to eat a really strict plant-based diet. And so I credit that with what's kept me alive all these years, so I really appreciate the work that you all do, definitely. But for my own career, my first business out of school, I graduated with a doctorate in physical therapy. I started a company called irehab.com, and it was the first app on the iOS App Store that treated anything. So I literally wrote the code for that out of my apartment in the Hilo Lagoon building, a mile away from here or so. And that became the 43rd most downloaded fitness app, and was listed as one of Apple's top 100 noteworthy apps. And so as part of that process, I went through the process of raising funds with an angel investor and scaling that business and then getting acquired. And so part of that experience today I'm going to speak to, so that any of you that have the same ambition of growing your business, scaling it, undergoing an acquisition, and then perhaps moving on to something else you want to do, I'm going to speak to my experiences, and hopefully that can be helpful to you all as well. So after iRehab got acquired, I became the key opinion leader in orthopedic business development for a company called Desktop Metal. which was the second largest 3D printing company, and they just got acquired recently. But I was able to do that work because I owned a physical therapy clinic in Kona, and we were the first to ever do 3D scanning to 3D printing custom devices for patients. And so that also underwent the process of starting with a small idea, scaling it, and then undergoing an acquisition. So after that, the funny thing about having your businesses acquired is you can't compete with yourself. So you have to go find something other than what you were doing to do, right? So the carrot and how I got into finance was Edward Jones said, look, we'd like you to share these experiences that you've had of scaling businesses and working with clients one-on-one towards their business goals, but also their personal finance goals. And so I'm also an adjunct professor with HPU. And then on the volunteer side of things, I'm the finance chair for the Knoll Family Foundation, which if you all have ever heard of the band Sublime, it's the family of the lead singer of Sublime, both past and present. And we actually have our annual fundraiser coming up next week in Oceanside, California. So we have a lot of bands come, and it's always a good time. And then I'm also the chairman for the Hawaii Island Community Health Center Foundation. And what we're trying to do with that foundation is we believe in expanding the idea of healthcare into both food security, housing, lots of issues around just wellness and well-being. So yeah, I'm excited to hear from everyone else and hear those introductions.
Wow, Brett, it sounds like you're a busy guy. How do you find the time? I like how you have such a diverse array of experience. And yeah, what a privilege to be able to have you joining us to provide some financial planning technical assistance.
Well, thanks. So to start off with, what is a financial plan? And it's essentially telling the story of your business, where you've come from and where you want to go through numbers, right? So a little more formally, we're going to look at some of the basic equations that would cover all aspects of your business finances, your income, expenses, debt, investment savings, all those things, right? And of course, why that's important is as you're scaling your business, if you have to apply for a loan or you want to work with an angel investor or a venture capital firm, and we're going to talk more about that, you're going to have these numbers. And so a financial plan should be a living document that you revisit once a year, check in, see where you're at, update your numbers. There's lots of reasons for this. Obviously, to provide clarity and direction, understanding, are your lines of service really serving you and providing for your lifestyle and what you're trying to achieve? The other piece is, and we see this a lot in the healthcare industry, where businesses are very busy. They think they should be very profitable, and then all of a sudden they find out they're not. And sometimes the business owners are being defrauded, right? And they don't know enough about their own numbers to even understand, right, if money's gone missing. And ultimately, what we'll talk about today is a little bit more with my experience of the venture capital background and how you really scale something that has high scalability potential. And so why a financial plan really matters, right, is to really just understand your income, the expenses you have, and ultimately, yeah, is the business serving you, and to create a roadmap, right? A financial plan definitely helps with a fiscal consciousness around avoiding taking on too much or unnecessary debt. One thing that I tell all small business owners, generally what you want to have on the personal finance side is 3 to 6 months of an emergency operating fund for yourself. For your business, you want at least 90 days as well of an emergency operating fund, right? That way you'd have enough money in the bank to cover your fixed cost. But But we're going to talk about how a financial plan relates to an exit strategy, whether that is selling your business to your employees, giving that to your kids, or selling that to a bigger holding company that acquires small businesses. Also, when you have a good financial plan and you've got just good, sound financials, you can do more for your employees. So one situation came up last week where I was working with a local business and they've had a really good year. And so I sat down with them and said, look, every dollar that comes in from now on is going to be in the 36-ish% tax bracket. We need to bring that down, right? So let's talk about doing a 401k plan for your employees and having a match, right? And let's try to keep you from having that high marginal tax rate and at the same time doing more for your employees. So if you've got sound financials right, you can start to look at those other things that make your business really, really sticky and allow your employees to really have a career within your business. So when it comes to raising capital, lots of different loan types, right? So most of you maybe have thought about, if not, have already gone through the process of approaching a bank or a credit union, somebody that works with small business loans and perhaps have looked into this process already, right? The first thing the bank's going to ask you is basically for a business plan with some metrics. And that can be a little difficult sometimes for small businesses to actually get loans from banks. But generally, right, there's loan periods from very short periods to very long periods, right, of 1 to 25 years. I have some business clients that don't have a loan, but they have a line of credit with us at Edward Jones. And so they basically have assets and then they have a margin account. And so they'll use that as kind of almost like someone would use a home equity line of credit, something that allows them to have some flexibility when they need cash. Of course, small business association loans. If you haven't approached the SBA yet, I'd say go on their website, follow the questionnaire, and you can go through the questionnaire and then it'll show you local partners, right, of banks and credit unions that are partners and will be approachable for small business loans. And so one thing to think about when you're asking for a business loan, think about what that loan is specifically for, right? Is it to acquire a property? Is it to acquire equipment? Some types of loans are easier than others. So Anthony and I were talking with one of the businesses that we're working with last week, and basically they're looking at mortgaging a property. It's like, okay, well, if that's difficult, it might be easier to get an equipment loan and then take some of that money that you would have bought equipment with and finance the property under the existing loan that they have, right? So there's lots of ways to skin things. So if you're turned down for a loan, start to think about, okay, what other loan type can I potentially go after, right? And the banks will be helpful with that. And of course, anyone that is affiliated with a small business association will be helpful with that. Generally, we consider a microloan anything under $50,000. That's generally what most startups are going to be eligible for that don't have a long history of revenue or profitability. And then, of course, USDA loans. What's important to know about USDA loans that's not always obvious is that these can be for a wide variety of things. It can even be for family living expenses if you live on your farm. So definitely check out their website as well and take a look at the questionnaires and see if your business is eligible.
And let me just add, for those of you here in person, there are a couple sheets about the USDA Farm Service Agency and the different loans that they provide. If you're not in person, like Brett said, you can check out the website. You just want to search for USDA Farm Service Agency, and they have a local office in Hilo.
So one of the problems I hear a lot about from our local small businesses is that it's hard to get a loan from many of the local banks. And only 45% of small businesses actually secure bank financed loans compared to 72% of large firms. And that is going to parlay in a slide or two into our conversation on venture capital and angel loans. If you have a business that has high scalability potential, and so I think in the food space, that's probably going to be more that your value add products of drinks, sauces, things like that, that really have the potential to go national, if not international. That's going to be where the venture capital and angel investors come in. So most banks locally require at least 2 years of current ownership. And small business loans, though, might be a little more lenient on that. So one thing to check out, too, is you can always look at banks outside of Hawaii as well. I've had a couple clients that had a difficult time securing loans here, but had an easier time with banks located outside the state. So that's always a possibility as well. I mean, it's always nice to go local, but at the same time, just so you're aware of your options, out-of-state banks are options as well. So when it comes to the financial plan and why that's important, banks will actually analyze cash flow, and what they want to see is that you've got something called a debt service coverage ratio of 1.25 or higher. So what that is, basically a bank wants to see within a given year, are you going to make at least 1.25 times what your annual debt payment's going to be, right? So let's just say hypothetically for easy numbers, if your loan is for $10,000, they'd want to see that you had net operating income right after taxes, everything else, that was at least $12,500, right, to be eligible for those loans. So sometimes they'll look at your projections moving forward. If you're close, maybe you're at one time the debt service coverage ratio, and they want to see 1.25. But if your business has been growing at 25% a year, you might still be a candidate. And so I'd say when you're applying for a bank loan, really, really think about your projected revenue and think about whether or not you're being too humble. That's something I see a lot, is that people are actually under-projecting what their revenue is likely to be. So typically when you go to the bank, they're going to ask for detailed financial statements, tax returns, and projections. And that's typically where people kind of turn off, to where it just feels a little overwhelming, but it certainly doesn't have to be. So one thing the bank is definitely going to want to know is specifically, what is the loan for, right? So you really want to get pretty granular of, are you expanding your business and you need equipment for that? And that's a common thing that banks actually like to see, that you're successful and you're trying to be more efficient. So an example that probably everyone's familiar with, so everyone probably has had sriracha before, right? So the founder of sriracha, right, he was at a time actually grinding the peppers and filling the bottles by hand. So he approached a bank and said, look, I could be like 50x more efficient if I actually had some equipment, right? So he didn't really have the revenue at the time to justify what the bank was asking for with the debt service coverage ratio. But he had good sales, and he had a good pitch, and the bank said, okay, this actually makes sense. So yeah.
I love that. I have not heard that specific sriracha story, but it's the same story for every big food business, right? They all started, for the most part, making their product in their kitchen or their mom's kitchen or their garage until they scaled up.
Yeah, and that's really where venture capital comes in, where venture capitalists are less concerned about the financials of where your business has been so far, and they're a lot more interested in the potential. So typically, when you have a small business that really has a ton of potential, but in order to reach that potential is going to have a lot of front-loaded cost. That's where a venture capitalist will step in, right? They're not as concerned with what your revenue is. They're looking at margins and potential scalability. So venture capitalists typically aren't interested in giving you a loan. They're more interested in taking an equity position in your business. And so everyone's probably seen the show Shark Tank. They themselves are venture capitalists, and I've actually had one of my businesses that I was an early investor in called Psionic, that we make bionic limbs, but they were actually on Shark Tank. It's a much longer process than it looks like on TV, right? Where on TV it looks like you walk in and then 3 minutes later you have a deal. Well, what you don't see is there's a couple months before that of back and forth questions where they're asking for information. They're asking for some of the mathematical formulas that we're going to talk about, and then by the time they get there, right, it's kind of just a final discussion for the most part. But yeah, VC firms usually don't want to loan you money; they want to be a partner. And the other piece that comes along with that, typically people in venture capital have a lot of past experiences in scaling businesses. So whenever you do approach a venture capital firm, which we'll talk about how to do, the thing you want to think about is, do they have expertise that's actually helpful to me? So when I was scaling my app business, I actually got approached by a number of firms. And I didn't take their money because the way I put it to my business partners, I said, this is dumb money. It's just money, but I want the expertise. I want to work with people in the industry. And so we ended up taking a deal where it wasn't as favorable in terms of the money they gave us, the equity we gave them, but I like that deal a lot better just because of the expertise involved. And so typically, there's venture capital and there's angel investors. And so venture capital firms generally want to get involved by taking 20 to 30% of your business and giving you somewhere in the range of 1 to 5 million. If you don't need $1 million or you're not to that point yet, typically you're going to be talking to an angel investor. And where you can find angel investors, I've seen a lot of these in Honolulu more than I have on Hawaii Island, but we have had these in the past where there'll be pitch events to where you can literally go and pitch your ideas, and there's probably someone in the audience that is there actually trying to figure out who they want to invest with. So for my first business, I started with an angel investor. That went well. He introduced me to a VC firm, and then we did our Series A round of funding. So in terms of how a venture capital firm will value your business, there's a couple different ways. So they might look at your annual earnings and add a multiplier to that. They might compare you to other businesses, and that's typically how most businesses are valued. Is VC firms will look for something in a similar space and say, okay, there's a similar business to yours. Based on how they were valued with their venture capital round, we're going to value you at 5 times annual earnings. In the tech industry, sometimes businesses are valued up to 75 times their annual earnings. In the food space, it varies a lot. When it comes to sauces and drinks, you can see anywhere from 1x up to 12x. So for the farm industry, it's more of a 3 to 6 times annual revenue for the valuation. And that valuation is based on, if you all have ever seen this acronym here, EBITDA. And so that means earnings before interest, taxes, depreciation, or amortization. And so basically that's just saying, how much did your business take in, right? Without any sort of financial gymnastics of pushing expenses to the next year, things like that. So it's basically just gross revenue in, for the most part, not factoring in expenses or depreciating those over time. And so these are some venture capital firms specifically in the agricultural and food service spaces. So what's a good idea if you think that you do have something that could really scale, go on their websites, fill out any of the contact info, and see what types of businesses they like to invest in. Some businesses in the ag space like to do more annual crops, corn, soybeans, things like that, right? Some are more interested in specialty crops. So you'll find something that's probably more aligned within that list there. And then down at the bottom, these are some local venture capital firms over in Honolulu. So they're not necessarily in the food space, they're more in the tourism tech space, but they do change their interests from time to time. They have evolved a lot in the past 15 years, so I think it's worth checking in with them as well. And so when you reach out to a VC firm, these are some good questions to ask, right? Of what types of businesses do you like to partner with? What's a typical funding round in terms of dollars? What metrics are they most looking for? And that's really key. A lot of times, when you're starting a new business, it's good to know these things, right? It's good to build it into your business model from day one. And so from the physical therapy clinic, Kalo Physical Therapy, that I owned in Kona, when I was first establishing that business, I found there was a publicly traded holding company that bought small practices. And so I actually called them and said, how do I make myself an acquisition target? If my goal is to sell my business to you, what do you look for? And they literally gave me 5 key metrics. And one of the metrics was dollar per square footage of your clinic. And so knowing that, instead of having office staff in the front of my clinic, I let them work from home. And that way I'd have less square footage, so I'd have a higher dollar per square foot figure, and just meet all their metrics very easily. And so that was really easy to do starting a business, knowing that that was my goal and that's what I was aiming for. And
a little sneaky.
Yeah. But the other thing you want to ask VC firms is if there are opportunities to pitch and receive feedback. And so there are some venture capital firms that really like to work with very early stage businesses more than others. Some like to work with more mature businesses. So I've definitely seen that where some VC firms say, yeah, pitch to me. I'm going to give you some feedback. I'm going to give you some ideas on how to make your business run better, and then come back, right? And people will keep doing that until a VC firm says, okay, I'm ready to give you money now at this point. So it's definitely not a process to shy away from. Because everyone that works for a VC firm knows how it is, right? That I think they're well aware that you can be an expert in your business, but not necessarily an expert on the financial side, and they appreciate that, right? And yeah, you can't be an expert in everything. So what the average VC firm wants to see, generally they like to see that you're not in a pre-revenue status, that you actually have some sales. The only time they're really interested in pre-revenue businesses is if it's something very high tech. Then at that point, they're willing to get involved. So the company I worked for, Desktop Metal, one of their projects was actually 3D printing live tissue. And so venture capitalists, before they went public, were very interested in that because they realized you're only going to get in on the front end of this deal, where once we're actually printing live tissue, that's going to be an expensive thing to get involved with. So they're willing to get involved pre-revenue, pre-FDA approval.
Okay, wait, hold on. We gotta go on a little tangent here. How do you 3D print live tissue, Brett?
So you basically, you have a very nutrient-rich matrix around stem cells. And then there's a machine called a bioplotter. So what you do is, if you were looking to grow a meniscus, let's say.
I am looking to grow a meniscus. Funny you should ask.
Yeah, you would actually MRI a patient, actually get the dimensions of their knee, make a mold, and then use the bioplotter to fill that mold, and then those cells would differentiate and form an actual meniscus. And you can do that with any tissue in the body.
You do that with any tissue, guys.
Yeah.
If we can 3D print meniscus, we can farm and make money, right?
A good tangent. Yeah, because your business and your business idea in the end, right, might not be where you started. You might come up with a different idea throughout this process. But yeah, with a VC firm, what excites them the most is this idea of margins. So a VC firm cares more about margins than they do about profit dollars. So in theory, right, if you had a business that had $1 million in revenue, but their margin was maybe only $50,000 of that, versus a business that had $200,000 in revenue, but $100,000 in margin, they'd be more interested in that business with smaller amounts of revenue. And so that again goes back to that idea of the value-added products tend to do really well in this space. Yeah, and generally what VC firms will care about is the unique value proposition, right? Of what is special about you? What are you specifically doing that's different than perhaps similar businesses?
Oh, that reminds me. I'm going to run and grab a value-added product that I want to show off that I think has the potential for something like this.
Yeah. Every VC firm will ask you about your exit strategy. And that's a tricky question because I used to get kind of a little annoyed by that question because I'm like, look, I'm just starting my business. I'm not thinking about selling it. But they will ask that. They want to see that you're thinking of who can you sell your business to? How can your business reach more people potentially through an acquisition? And with an acquisition, it doesn't necessarily mean that you're out of a job, where a lot of times with acquisitions, there'll be an agreement to where you'll actually stay on as a role. Oh, what do you have here?
So this is Hamakua Coast Premium handcrafted syrups. This one is Mackay Road Roselle. Can we get a zoom in on that? Hold on, we have the technology. From the slopes of Mauna Loa and Mauna Kea, our Mackay Roselle enhances cocktails, mocktails, and other culinary creations. Come with us and enjoy the flavors of Hawaii. Ingredients: Roselle, pure cane sugar, water, citric acid. That's it. And these guys are actually in the process. They took over the old Hawai'i Commercial Kitchen, which has been closed for many, many years. They're manufacturing in that kitchen and are the newest members of the commercial kitchen cohort. So they're going to be opening their kitchen, excess kitchen space, and renting it out in Hawai'i. So what do you think, Brett? Is this a product that you could see getting picked up?
I definitely think so.
I guess it depends on what the profit is, right?
Yeah.
What the numbers say.
You can always make it work, right? It's yeah, you can always find a way. And on the next slide here, so probably some of you all are thinking, okay, what if a venture capital firm's not really for me? What if I don't qualify for the bank loan just yet? What are some other options? So there's a category called startup incubators, right, where there's a number of these throughout the state. So incubators or accelerators will generally work with business owners for a 3 to 4 month period, give them some startup capital, and at the same time bring in experts, kind of like we're doing now. So yeah, in no particular order, here's some either shared space, food hub, kind of commercial kitchen type operations, or incubators to check out. And then the next question, back to that idea of exit strategy, right? Of what is your exit strategy? Here are generally the different ways that people kind of move on successfully from their businesses, right? Either an acquisition, and we know that farms generally get bought in the range of 3 to 6 times their annual revenue. Sometimes an IPO for companies means going public. We've seen this happen with like Hanson Beverages, right, that owns Monster Energy and a number of other brands, right? They went public, and now everybody that owns shares essentially owns the company. A buyout plan where if you have employees that want to buy the business, there are definitely ways to do that are kind of fair to everyone that I can talk with you about, privately. Of course, secession of transferring to family members, or the last one, liquidation, just selling assets. So this isn't necessarily a fail. A lot of the small businesses I work with, sometimes, like I have a client who's a dentist, and this firm wanted to buy his practice. They said, okay, well, as part of buying this, we want you to stay on and manage the clinic for 3 years. He said, well, I'm not going to do that. I'm 70 years old, right? So we ended up deciding that for him, it probably made the most sense just to sell what he had. He had a lot of equipment, made good money, and then he was done. He had no obligations. So that can make sense as well for you. And so here are some examples locally of successful exits where, Mauna Loa, or Hershey acquired Mauna Loa and then sold to Hawaiian Host. Island Princess, which makes Mac Nuts, acquired a Japanese gift company. And the idea was they wanted a further reach. And according to their metrics, they thought, wow, if we can really reach the Japanese market more efficiently, we can really make good margins on our products. But they didn't really have a way to do that. So by acquiring this gift company, right, they were able to do that. And so really, really an interesting way of thinking outside the box there. Irresistible Foods acquired Shaka Tea, which was amazing to see. I remember first seeing Shaka Tea on the shelves, and to see that they underwent an acquisition, pretty wild. And then one I read about recently, of course, me as the vegan, I'm one to talk about butcher shops, right? But I was always surprised that there wasn't a butcher shop on the island. And so, as it turns out, Parker Ranch has stepped in, and the terms with this were undisclosed, but they have some kind of equity agreements where they're a partner now with a Waimea butcher shop. Yeah, and so on the next page, so these are publicly traded holding companies here. So you can actually look up these ticker symbols, like for Farmland Partners, FPI, and you can actually see what their stock trades for. What I love about holding companies is that any company that's publicly traded, you can learn anything you want to about them, right? And so you can actually see if they buy small farms, well, what does a really well-ran, efficient small farm look like in terms of metrics? All that information is public. And the reason it's public is anything that's publicly traded on the stock market, nobody can have an advantage, right? So in theory, every person has to have access to the same information. So you can really, really use this to your advantage of understanding what your metrics should look like. And so this particular holding company tends to acquire farms in the 100 to 2,000 acre range. But kind of like I did with my physical therapy clinic, you can literally call them and say, okay, I've got a farm that's 100 acres. If I wanted to become a target and be acquired, what would that look like? What would you need to see from me? What would the terms be? And so that way you can see if that's an option for you, or if that's something you want to keep looking, in a different direction for. But there are actually quite a few of these that are publicly traded. They all tend to focus on slightly different things. Like this next one here, Gladstone, they tend to focus on anything from 50 acres up to 5,000. And more permanent crops, almond and berries. Yeah. So definitely check these out. And yeah, a treasure trove of data. Really, really look at their metrics. And definitely reach out. They're always happy to have a conversation where when I started my practice, the holding company that I ended up working with, they were really, really happy to have a conversation on the front end. So as far as actual numbers and data that you need to have, the first part of developing a financial plan is look at your potential funding sources, right? Whether it's personal savings, small business loans, asking family and friends for money, if you're grant eligible, maybe you can crowdsource. Lots of options these days. There's never been more options at this point, right? But you want to get a sense of maybe who you want to ask for money, and then pencil in some numbers of what you think you might actually get from any of these sources. So another thing that any venture capital firm or any bank is going to want to see is revenue projections. And if you have a couple of year history, look backwards as well, right? So give them the actuals of what you actually sold, how much you sold it for, what your total revenue was, and then project that forward and give reasons why, right? And so that's going to be a little bit different for everybody, but typically any bank or any venture capital firm, as long as it makes sense, your projections, they'll go with it. So it can be as simple as, well, we've been growing 25% a year, or I've had other businesses say, well, we grew at 12%, then 25%, so we're growing exponentially, therefore our projections reflect that exponential nature, right? So as long as you can explain it and it seems plausible, that should work for most lenders there.
I've found, Brett, tell me if this has been your experience as well. People have a really hard time valuing their business, and it's kind of hard to wrap your head around in terms of like when you come up with your valuation, you do essentially just make it up. It's not like you're just imagining numbers out of thin air, but you're making it up with all of the historical data that you have access to and the what other businesses are doing in the same market and around the same size.
Yeah, and that Anthony's right, where people have a hard time thinking about that, and part of your projections can be just the market itself is growing. Earlier this week, we were looking at the durian market, right? And that's growing at an estimated 7.2% compounded annual growth. So you could even factor that in addition to your own projections of what is the market itself doing, right? And that can sometimes be really inspiring for lenders to go like, okay, not only is their business growing, but the market itself is growing, right? So just lots of growth happening both in and around the business. And then something that that lenders are going to want to know, how do you price your goods and services? How do you come to these price points? Especially venture capitalists, they're going to want to know, are you being too cheap? Are you selling your product for cheaper than it needs to be? And so you want to insert some explanation in your financial plan of how you got there, right? Is it that you're trying to hit a certain margin on every product? Are you pricing it relative to the market? Are you pricing your products differently in different markets, right? Where something that you could sell in Kona at a farmer's market for $2 might be $1 in Puna, right? Just because the Kona market can accept that higher price point. And they want to see that you understand the market and how to price your goods. So when you see the term operating expenses, this is just going to refer to the cost of running your business, right? So rent, utilities, salaries, and then cost of goods sold. What that refers to, and that's going to be probably the one thing on here that isn't familiar, potentially. So that's going to include the raw materials and direct labor. So the analogy I use with that, if you were making a pizza, right, that would be the cost, the labor cost of the person actually, rolling out the dough, and then the cost itself of the sauce, the cheese, the toppings. You can include things like electricity within that, right? If you have, let's say, a food truck, that could include, the gas, anything that's directly tied to making that product that you're selling. And so the cost of goods sold wouldn't include any like HR related expenses. It wouldn't include expenses of, let's say if you're the manager, but you're not directly making that product, it wouldn't include any of your salary data there. So if that makes sense. And then basically at the bottom, you would just total that up of your total operating expenses. And then for any lender, they're going to want to see, has this changed radically within the last year or two? And if so, why, right? Because sometimes I've looked at these from businesses and I'm like, okay, that doesn't make sense. Why do they have so much more expenses this year than last year? And then they'll explain to me that some of their equipment was at end of life. And then once they explain it, it's like, okay, that makes sense. So it's always okay to include a narrative with those numbers as well. And then you're definitely going to want to include a profit and loss statement. So revenue, just all dollars in. Of course, cost of goods sold, we've already talked about that. And that's, for cost of goods sold, you could do that per unit and then in total, right, in aggregate. So gross profit's going to be your revenue minus cost of goods sold. And don't worry about memorizing any of this. These are all common equations that you can look up examples for online. And then OPEX, or operating expense, would include kind of everything else outside of the cost of goods sold, right? All the other expenses that aren't directly tied to making that particular product. So within the operating expenses, you would include taxes. And what I always ask businesses to do, if possible, is include from their CPA their marginal and effective rate. And so what that means, when you pay taxes, it's a graduated step-up basis, right? So on the first $10,000 you make, you pay 10%. On the next $12,000, you pay 12%, and so on.
I want to pause us because this is a hugely misunderstood concept about when you're paying taxes. So just to extra focus, listen up on this. When you're paying taxes, you might think like, oh, I'm making more money now, my tax rate goes up, and you have to pay all of your income at that higher tax rate. That's not true.
Yeah, and unfortunately, I've seen businesses struggle because they were basically keeping their own books and doing their own taxes. So they were prepaying 30% a year in federal taxes, like a straight 30%. And they said, well, we're in the 30% tax bracket. It's like, well, your effective rate, you're only at 19%. It's only the last $20,000 that came in last year were taxed at 30%. And so they were putting all this money on the side, overpaying on their taxes when they could have been investing more throughout the year. And they go, oh, well, that's why I got such a big return, the year prior. And I go, yeah, that's why. But meanwhile, right, that money was tied up for an entire year when it could have been growing with the business. So the effective rate is one number, right, of combining like that 10, 12, 15, just down to one number. And the marginal rate is what was the most expensive tax rate that you hit, right? And with your profit and losses, you're going to want to reflect that on a quarterly basis and then an annual basis. And so that way the lender can see, do you have some costs that are higher in certain times of year? So I think especially for a farming business, right, where crops might be semi-annual or annual, the numbers can look a little funny if you're not breaking it down quarterly. And then a cash flow statement. And so what this is a lender's going to want to see what is your average balance month to month, right? Do you have pretty steady cash flows? So like at my physical therapy clinic, we pretty much always had the same amount of money in the checking account. There were very small fluctuations. Other businesses, right, might go way up and way down, but they want to just understand, where is the money flowing to and why? And so generally for cash flow statements, we pick the 20th day of the month, just because it's between pay periods. And so you can pick a different date if for some reason your pay periods don't line up with the usual kind of 26 pay periods a year that you'd expect in the 15th and the 30th type of thing. Which, yes, there are 26 pay periods. It sounds funny, but with the 2-week model, right, it does work out a little asynchronous. And just explain any dips. So, like for instance, I'm on the finance committee at the Community Health Center, and I was looking over our financials, and I'm going, whoa, like why did we spend like 90% of our travel budget in the first quarter of the year? And then when we looked back at it, we're like, oh, it's because that's when everyone goes to DC to lobby, and then we don't really do anything for the rest of the year. So it made sense. But when I was initially looking over the metrics, it just kind of grabbed my eye as a big number. And so if you're making these charts and you yourself see something that you're like, wow, it looks a little odd to me, just explain it so that the lender doesn't have to wonder. And then the good old break-even analysis, which will tell you how many units of a certain product you need to produce to break even. So in terms of what a fixed cost is, I call these your COVID costs. And so for those that may have had a business during the pandemic that couldn't operate but still had very real costs, like rent, salaries, maybe liability insurance, right? Any costs that you can't really turn off, those are going to be your fixed costs, right? Monthly bill for your company cell phone, all those kinds of things, right? Versus a variable cost, which would be a cost that would be associated with doing business. So an example of this would be, let's say you have a truck for your business. Well, the fixed cost would be your monthly payment. The variable cost would be if you're driving that around for food deliveries, right, and you're spending more in gas based on the more deliveries that you're doing, right, that would be then your variable cost. So anything that's actually tied to doing more business above the baseline there. So that can include overtime dollars as well. And so that your break-even analysis would be your fixed cost divided by the price that you actually sell your good for, minus your variable costs or the extra costs involved with producing that. So you can break this out per line of service. So if you sell multiple products, you could do this for that. You could lump sum it and say on average, based across my product lines, this is our break even. So there's a couple ways to do it. If you have a service-based business, you then have to break your time into a unit, let's say. So I know like some of the businesses involved with the food hub have a consulting aspect to it. So you can literally break your time down into 15-minute intervals and treat it like a unit being sold, essentially. And then just the balance sheet there. When we use the term owner's equity, that's in dollars of what you would have if you tallied up all your assets minus all your liabilities. And where this gets a little tricky, I was talking about this with Anthony, is some things are both an asset and a liability, right? Where if you buy a vehicle, the asset portion would be what you've already paid off, and the liability would be what you still owe, right? So one item that you could split those costs into both an asset and a liability category. And that goes the same with any equipment. And so owner's equity and total equity, I put those both on here, even though they're the same thing. Total equity is just kind of the term you'll see more commonly used for big businesses that have 50 to 100 employees. You'll see that term instead of owner's equity. And then accounts payable, that's different from loans payable in the sense that that's money that you owe suppliers, right? So basically, like Costco, they owe their vendors every 60 days money for the goods and services that they sell, right? And so it's not a loan, it doesn't have interest on it, it just has to be paid at some point. And I'm sure you all have accounts payable like that as well. Whether it's whether you cook with propane and every month you get that invoice, it's any invoice that you're getting and you're having to pay.
That you haven't paid yet.
Yeah, that you haven't paid yet. And then the loans payable, of course, would just be anything that you have outstanding. And why this is important is lenders generally want to see the loans that you have. They want to see what interest you're paying. They might even give you ideas on how to consolidate that and perhaps get a better loan. And then,
so I have a question real quick. What if you add up all of my debts and it's more than all of my assets? Does that mean I have negative owner's equity?
Yeah. In that case, yeah, you would have negative equity. Yeah. And then this next slide here is really important. Typically, when most small businesses are approaching a lender, a common scenario I see is, we want to start a new line of business. Here are the costs associated with this new line of business, right? And if it's an equipment loan, just have it make sense, right? Of what's it going to cost. We already talked about the projected growth, right, of revenue and what the market's doing. So they just want to see that the equipment cost makes sense with the projected growth and what you're trying to do there. Kind of like we said earlier, where plans are good, but don't be afraid to pivot, right? You might come up with a really good idea after you've already come up with your business and financial plan. So that happened to YouTube, where YouTube was actually a dating site, pretty small niche market, and then they're like, hey, what if we just pivoted and just allowed people to post videos on everything? Be a way bigger market, right? So they just pivoted. This next one, Brian Company here, is a really interesting one where there was a failing family farm in the Midwest to where they literally were going to lose their farm, and the son of the farm owner actually went to engineering school. He goes, I think if we started making corn into biofuel, we could actually generate a lot more revenue per acre. And so that's what they did. And now it's $1 billion business, right? So from failing farm to $1 billion business. And of course, they're producing fuel instead of food, but those fuel inputs are then used by other farmers to produce food. So it kind of feeds back into the system. Starbucks actually started off selling equipment for home brewers, people that wanted to make their own coffee, and then had a hard pivot, realizing that, yeah, you can actually have lots, a much higher margin if you're doing the value add portion of that yourself, making the coffee and then selling it back to people rather than allowing people to do that for themselves. And then Eat Offbeat is a really cool business in New York City where they're a catering company that my family's actually used before, and they kind of pride themselves in being a first-generation immigrant business. But when catering started to have big problems during the pandemic, they pivoted and said, well, let's do food boxes, let's do meal boxes, and that took off to where now catering is actually a pretty small portion of their business, and the meal boxes have really, really taken off. So they used the pandemic to their advantage, right? Rather than just kind of folding and saying, this is too difficult. And then Hoi Fung Foods, of course, the sriracha folks, where the owner came to the US, and at first he was just selling sriracha to Chinatown type markets, and then thought, hey, maybe everyone else would like this too, right? And then pivoted towards more of an industrial model. So definitely some things to keep in mind. And then here's my contact info. And so please reach out anytime with questions about your business. But then I also help with individual financial planning too. So whether you want to set up retirement plans for your business or for yourself, or just want to talk about your retirement goals, I'm definitely available to help you all with that.
Beautiful. Thank you so much, Brett. Let's go back through the questions and we can see what people want to know about. And we can probably do a little live Q&A if people want to ask. Jonathan. Yeah, why don't you... Yeah, go ahead, Jonathan.
How's it going? Sure. Yeah, I just popped this in the chat, but you mentioned, that you get useful information on kind of how to make your business operations more efficient based on what people who do this professionally are doing from holding companies and their reporting. That sounds great, but I'm not very familiar with like how to find these tools, how to find the reports, what kind of information to look for. And I was wondering if you could speak to that.
Yeah, so one thing you can do, if you type in Farmland Partner full year 2024 results.
Uh-huh.
Yeah, it'll give you a lot of information there. I mean, eventually you can whittle down in the report to kind of, what kind of revenue per property they're producing, where it's going to have a lot of gross figures in the top of the report. But it's also something that you can email them to and say, look, I've got a small farm business. Can you send me some metrics that you'd be looking for? And they'll send you something that's a lot more boiled down than that, typically. So that way you're not looking at kind of the data from all their properties combined.
Sure. Okay, that makes sense. Right.
Yeah.
And it's mostly about what the financial metrics are and less so about how it's harder to get information from a report like that on like how they're achieving that metric or that efficiency.
Yeah, and the other thing you could do, you can literally copy and paste some of these reports and put it in your favorite AI engine and just start asking it questions based on the report.
Right. Sure. Okay, thank you.
Yeah. Yeah, the one thing I should say too, when it comes to actually developing those metrics we talked about for your business, the easy way to do it, anytime I've ran and scaled a business, I've made sure that everything interfaces with QuickBooks. So our payment terminals, our checkings and savings. So that way QuickBooks just does all this. And then I'm just literally just putting the data in the chart at that point, and I'm not actually doing any of the work to come up with those metrics. It's just all there already.
Okay, I have a question while we are waiting. What do you think about borrowing money from family?
Yeah, good question. So I'd say treat them like business partners if you do that, and be formal about it. Actually write up an agreement and know the rules before you play the game. Where when I've seen people borrow money from family and it's been a loose agreement, that tends to be where a lot of the problems come from. Where anytime it's been a formal agreement, it's like, hey, you could lose money. Here are the terms. Even when things don't go well, that seems to not go as sour as far as family and friend relationships.
Yeah. Got it. So have a formal agreement. Okay, Lyman, you're up. So, well, I will just ask in general, your question is, how do you make labor costs realistic? Since farmers, food service often work for free or cheap. I think you mean if you are the one starting your new food business, you often have to work for free or cheap starting out.
Yeah, that was another thing that came up when Anthony and I were working with a group on Monday, where if you're just putting in sweat equity to where you're just working for free, the thing you're going to want to explain to a lender is how are you going to sustain yourself, right? Where like, great, you're working for free, but how does this work? Like, how are you going to pay your bills? And usually the way people answer that, right, is they've got another job. And then the bank says, okay, all right, you're willing to put in sweat equity. They love to see that. And at the same time, this is actually doable, at least for a certain amount of time. But feeding forward, when you get employees, yeah, you're going to have to project in your projections. When your business gets bigger than you, then yeah, you're absolutely going to have to use market rates for labor.
Sorry, if your business plan involves you not making any money or not being able to pay your employees the minimum wage, then you need a new business plan. You need to tweak it. You got to crunch those numbers.
So the one thing I'll add, I think most of the time people are so focused on their product and what they're selling and doing that well. And a lot of times a lender will take a look at this and say, you know, you actually provide your product well. It's the other expenses associated with your business that you need to clean up. So you can have a good business that has a very low cost of goods sold, but at the same time maybe has a high cost when it comes to HR related expenses or something else, right? And so it's not only the thing you do, but it's all the other things your business has to do for compliance and everything else that can sometimes eat into your margins. So a common scenario that comes up, sometimes small businesses will ask, should I have my billing done by an outside party or should I do that in-house, right? And those are things that a lender will sometimes come back and say, you know, you'd be a lot more efficient if you just brought this in-house, you know, you're to that point. So those are some things to think about as well of, you know, what you want to outsource versus eventually insource.
Okay, we got a question from Brooke. In the spirit of COVID times, how do you recommend small businesses prepare for or weather economic downturns?
Yeah, that's a great question. I would say make sure your money is making money. And so any money that you don't need for your 90 days of operating expenses, that's usually where I come in, of people going, I want to do CDs and money markets. I want to be earning some money off of my money. But yeah, I think the key thing is to be nimble always. And I think if you're operating efficiently to begin with, then when there is a downturn, you'll be able to pivot more quickly, right? But I'd say too, see those challenges as opportunities. And anytime that you can explore something else new, great. But yeah, COVID was definitely a tough one, right? It definitely wasn't expected and had an uncertain timeline. But yeah, save as much as you can and get your money working for you.
Yeah, I like that. It's not about just making money. It's about having your money make money for you. And then, yeah, the flexibility is so important. Everybody had to pivot in COVID. You shut down or you pivoted. Nobody was, the status quo. Let's see, we got a couple more questions here. Do you advise creating a formal exit plan early on, even for smaller new businesses, with the hope of selling the business in the future?
Yeah, I think that's a great idea because for one thing, it becomes a thought exercise where as you're doing that and you're revisiting your annual financial and business plan, you're going to keep looking for different things. And yeah, so I think it's constantly an exercise to be engaged with. it's kind of funny how I ended up selling my last business. I used a billing service. And I had prepared to be an acquisition target. What I didn't know is the billing service actually sold a book of leads to a venture capital firm. And they said, we know what people are making that use our service, and we know some information about their business. So I actually started getting calls from firms, which I didn't expect. I had no idea that this billing service had another line of service, which was basically selling information. But it worked out in my favor because we got a lot of attention that way. So even though you might be looking for an exit strategy, people might be looking for you as well.
Lyman is asking, do you have business templates that you like, and how about a project manager app?
Yeah. As far as a financial plan template, that handout that we uploaded, you could use that just to get the basics down. Project manager app. I've always personally just liked Slack, where I've used that and just kind of broke it out into different channels. Anthony, do you have a favorite one?
I have used Slack. I've used Asana. I've used other less memorable ones, and I personally don't use any of those things. I prioritize all of my tasks using Google Keep, actually, which is just like a notes app through Google. And I have different lists for my different businesses, if you will, and I keep those lists, in order of priority. So the thing at the top of the list is the most important priority task. Yeah, I've found the project manager apps to be like one more project I have to manage. But I know other people that really enjoy them. And Lyman wants to know if you have an AI that you prefer for business.
Yeah, I actually like, even though it's a more controversial one, I like Grok. I hate to say it, but I like it because it'll give me answers that other AI engines won't. So sometimes other AI engines will just say, well, consult a financial planner. And I'm like, well, I am a financial planner. I'm trying to see what you can do, right? And I'm trying to see if I can actually run some of these complex equations that we do for clients more quickly. And Grok is the only one that'll actually do that for me.
Lyman, I really only use ChatGPT. I guess I'll probably try Grok. I don't have a Twitter account. Do you need a Twitter account?
I don't think so anymore. I think it's separate now.
Got it.
There's a different app.
Cool. Good questions. Anyone else have any questions? What is money? Just kidding. That's just a joke. So we will hang out for a little bit on the Zoom, but I'm going to go ahead and officially close this workshop. So thank you, everybody. Thanks, everybody out there in the interwebs. Yeah. And thank you, Dr. Brett Carey, for joining us. This has been another episode of Hawai'i Commercial Kitchens Technical Assistance on Financial Planning.